Good morning, everyone. Welcome to Plenary Session 3. We're going to be talking this morning about how have debt managers increased the attractiveness of local currency debt. As you have heard in other sessions, in the end of this forum, you're going to be receiving the complete bios and presentations. But I would like just to make a short introduction, like starting with myself. I'm Anderson Silva here in the bank. I manage the government bond market development product line, collaborating with several of you on this theme of how to increase the attractiveness of local currency debt. How we organized this panel today is that we invited 2 countries and an investor that is very heavily involved in emerging market investing. Starting here on my left side, from Brazil, we have Otávio Ladeira de Medeiros. Very short introductions that Otávio heads the Public Debt Strategic Planning Department in the Brazilian National Treasury, has over 20 years of experience. We worked together for many years in my previous life in the Brazilian Debt Management Office. And Otávio has also worked as consultant for the World Bank and IMF in several countries. So he is also collaborating the development in a broader scale. We are also happy to have here from Romania, Stefan Nanu. Also, we work together. Stefan is a General Director of Treasury and Public Debt Department in the Ministry of Public Finance in Romania. As General Director, then he's responsible for all type of dimensions in managing the public debt, responsible for the front office, middle office, back office. But previously to joining this position, Stefan was here in Washington for several years. He was advisor to the Dutch Executive Director, and then he was alternate Executive Director in the Dutch Constituency Office of the World Bank. And last but not the least, we have Denise. I'm really happy that she came from New York, joined us this morning. Denise is a managing director at Lazard Asset Management. It doesn't show, but she has a long experience in the investment field since 1986. She has been working as trader and very senior positions. She's a portfolio manager analyst on Lazard now, but she has worked in places like HSBC, Asset Management, Lehman Brothers, etc. And very importantly, she has been really one of our best collaborators in the dialogue with debt managers, participating in several of our events, and always with very, very significant and important feedback to you on how policies could be implemented to attract investment. So we're very happy to have this panel here. Just as getting back to the theme, just very, very shortly as an introduction, just a few facts. No? You all know that local currency debt really now predominates in the portfolio of debt management in emerging markets. Now this is around 90% of emerging market debt is in local currency. This was a significant transformation in debt portfolios that happened, especially in the first decade of this century, backed by macro fundamentals, backed by benign international environment, but also what is important to tell is that there was proactive debt management strategies behind that to shift to local markets. We are going to be talking about this process today, on how this changed, but what is very important, like especially compared to the discussion we had yesterday about how to see the scenarios for this, for local currency debt and investment in emerging markets, what we're going to be focusing today here is that this proportion of domestic debt has stabilized at around 90% in recent years, and then that brings the challenge on now, it's not really how have debt managers increased the attractiveness, but it's more than that. It's how now to keep the attractiveness of this debt, how to deepen the markets and make them more liquid, and how to deal with moments of volatility that we know that this will come. So these are the issues that we're going to be trying to cover here this morning. And then for that, I would invite, like by alphabetical order of countries, I'll invite Otávio to present a bit on the background of the Brazilian debt and also of some of the measures they have implemented. Otávio. You can speak your name.
Thank you, Anderson. Morning. Before starting to talk about the measures that Brazil has taken since the last 8 years or 10 years to attract foreign investors to our country, I would like to highlight some broad view of the Brazilian debt. First, what you can see here is that the foreign participation or debt 8 years ago was strongly concentrated in our external debt, debt issued in hard currency outside Brazil based on foreign law. And just a little bit more than 1% was debt foreign investors buying our bonds domestically. And 87% was held by Brazilians domestically in our currency. And then 8 years later, what you see is a very interesting new picture. 75%, 76% of our domestic debt, our total debt, is held by Brazilians in our domestic market, in our currency. 19.4% of our domestic debt in our currency is held by foreigners. And less than 5% of our debt is external debt in hard currency. So a total shift towards our domestic market. Interesting to see that despite the number 19 or 20% is sometimes being seen as lower than some other emerging market countries, but the number is not small. It's very relevant considering the size of our debt. We're talking about 2 trillion reais, roughly $800 billion in total debt. So the foreign participation is something like $170 billion, maybe the biggest foreign participation in a domestic debt among the emerging markets. So it's very impressive, the number. And when you see the flows since 2006, you see that the numbers we are, together with Mexico, the two countries that most received foreign flows to our bonds. Also, the same picture, but opening other participants, other holders, you can see that since 2007, we have moved basically from financial institutions, mutual funds that reduce their participation, and of course our external debt, our debt in hard currency, they reduce their participation. And the groups that increase their participations are the pension funds, all domestic pension funds, insurance companies, domestic insurance companies, and the foreign participation in our domestic debt, that 19.4% that I mentioned. So an important shift towards more structural, long-term way of financing compared to the previous picture. In terms of the countries holders of our domestic debt, they are a little bit similar to what you see in our foreign issuances, of global bonds and BRL and Euro bonds. As expected, concentrated in the United States, but surprisingly, some years ago it was a surprise, not nowadays, but Japanese retail investors, they are very representative in Brazil. China funds in general, sovereign wealth funds, central bank, and other institutions, they are very concentrated, and low representativeness of Europe. That compared to our external issuance is a surprise, because in our external issuances, Europe is more represented. maybe the most important element that brought foreign investors to Brazil was the strengthening of our economy, macroeconomic stability. Almost 10 years of primary surplus higher than 3%, declining our net debt from 60% to 35%, inflation under control, reserves enough to pay, international reserves enough to pay our public and private external debt. So in a very unique situation compared to our history, very strong position, not for the reason. We are moved to investment grade, but the first time in our history, in 2008, 2009, and then continued since then as an investment grade country. And then, in terms of additional elements that I would like to bring to you is the communication transparency. We created in 2001 the Investor Relations Office to deal with all groups of stakeholders, press, investors in general, rating agencies, IMF, OECD, all actors that could somehow affect the perception about that. We participate in discussion with them to enhance the perception, to reduce the misunderstandings about debt management in Brazil. Regular road shows, teleconference with investors. In terms of transparency, we created in 2001 the annual borrowing plan, in 2004 the annual debt report, in 2007 the monthly debt report, documents published regularly presenting precisely the conditions of our debt, targets to the end of the year, objectives, guidelines, long-term strategy, optimum debt composition. All these elements are being considered to let very clear for investors, analysts, where we intend to go, how we are doing in our daily operations. Also, we release our annual debt calendar. Is published the strategy in terms of auctions. We have 3 kinds of auctions that I will mention later. Traditional exchange and buyback auctions for several bonds. So we publish our yearly calendar, and then we publish a quarter calendar to open additional information. We also created, to increase liquidity in the market, some benchmarks for bonds. I mean, the bonds outstanding in specific months of the year. So in the case of our, for example, fixed rate bonds, our fixed rate bonds, the outstanding in January, April, July, and October. Our inflation-linked bonds outstanding February, May, August, and November of each year, and floating rate debt March, June, September, and December. This is a strategy to increase the liquidity on these points of the calendar. In terms of debt composition, we moved our debt composition from floating rate and external debt in dollars to fixed rate and inflation-linked bonds. The fixed rate bonds are the most interesting for foreign investors. 80% of foreign investors' portfolio in our domestic debt is in fixed rate bonds, mainly in long-term fixed rate bonds, but some short-term bonds also, and 20% is inflation-linked bonds. So this movement towards this kind of debt composition attracted the foreign investors also to our domestic debt. And again, using the element of liquidity, we, as I mentioned, we create that benchmarking for fixed rate bonds, and this guarantees good liquidity in our bonds. Just to have an idea, the green dot represents the amount of daily turnover of our bonds in our currency, so we can divide by 2 or 2.5 to see the number in dollars. So we are talking about, for example, for the shorter end of our yield curve, something like between 300 and 500 million dollars per day our daily turnover. So it's an interesting amount to be managed every day, and it helps a lot the investors. And I would like to use the opportunity to bring a question to Denise about what matters, because usually the debt manager uses the daily turnover as a percentage of the total stock of a certain amount on that time, so 1%, 2%. Our perception is that the amount matters, so more than the percentage in each point. Despite sometimes for comparison among countries, we see we use a percentage. So I'd like later hear from you your perception about that. And then we create this kind of good liquid market for fixed rate bonds. That's very important, not only for domestic, but mainly for foreigners. And someone could say, well, you are concentrating a lot your debt in some points. For example, you're talking about close to 100 billion reais, so $400 billion, sorry, $40 billion in a specific point. So on the other hand, we keep a certain a cushion at central bank, an amount of resources at central bank, our central bank, to pay at least 3 months ahead of our debt. So we always have a cash position exclusively to pay debt, to pay the following 3 months of our debt. And the return of these resources are market-based return, so we do not have any problems in terms of mismatch, in terms of the return. It's very important for us to manage our... That's it. Okay, thank you.
No, thank you very much, Otávio. I think that you provide us a lot of ammunition for the discussion, talking about all the measures from transparency, reporting that you have, and the organization of maturities, participation of the investors. And I think that one thing that is also remarkable in Brazil that it's worth a discussion is the share of inflation-linked bonds that is really above what we're observing in other countries. But we can come back to that. I would invite now Stefan to also provide us some background. The way we are doing is to provide this background so that you get more familiarized with what Brazil and Romania they have done, and then we shift into a more active discussions on all these inputs and insights we're getting. So Stefan, please.
Thank you, Anderson. Thank you for inviting me here. Since Anderson told me from the beginning that I don't need to prepare any slides, so I followed his advice. So I will not go through slides, but I will go a bit back in time to give you retrospective developments in our let's say the way we develop the market. I think going back in before 2007, I think we had a rather ad hoc type of policy when it came to funding policy through the domestic market. It was also pretty opportunistic. For those who do not know, so basically Romania started when the communist collapsed. We started from a zero public debt. And when you speak about developing a market, so I think size matters. So we came up from a very low basis. So in 2005, 2006, so we had 15% public debt to GDP. And then, it was easily for us to fill in our funding needs by borrowing from multilaterals or going with some bilateral loans. While that was done on the expense of, let's say, lower level of issuance on the market, and it was scattered across many instruments, many T-bills and T-bonds. While sometimes we even refrain of issuing in the markets because we had also a kind of institutional arrangement which created perverse incentives. So we borrowed temporarily to satisfy our needs by using the cash balances of other entities which were basically obliged to keep the account in the treasury single account. So that created periods in time, like for example 2005, 2006, when we were out of the domestic market completely. So that created big problems and criticism, rightfully so, from the market. I think one big trigger which started the development of the market was the first debt management strategy in 2008, when we basically explicitly had mentioned an objective to develop the government securities market. And we announced basically the policy of issuing benchmark bonds and becoming more predictable. So from that moment in time, we started having yearly calendars announcing the amounts to be issued within a year, also the instruments to be issued, and the frequency of the auctions. We used primary dealer system, but the system was I would say very simple, and the balance of the rewards and requirements was not a good one for the sake of development of the market. Then another important thing was the appearance of the institutional investors, and I think the implementation of the private pension pillars, second pillar and third pillar, was important for us. Our investor base domestically was basically very much dominated by the commercial banks. They still hold a very important part of our domestic debt, so it's about 54% as of today. It was much higher in the past. Now we have the pension funds holding around 10%, and also the insurers, mutual funds and other fund managers, as well as the retail investors, they have the remaining part of the portfolio. Of course, when the crisis hit, so we went through, I would say, a very interesting phase of development of the market. So in 2009, it was really very difficult to issue on the medium term and long term of the curve, so we issued mostly T-bills. But we called for external package from the multilaterals, and in that way we bought in a way protection, and so we were starting to develop the market also, then to build up the yield curve. Of course, the macro fundamentals were important, and as in the case of Brazil, the achievement of the investment grades triggered a lot of interest, both from the local investors and non-resident investors. But I think one of the most important thing was the inclusion in the international indices, in JP Morgan index, in 2013. That basically shifted. It was a completely change of the game. Phase. So at that time we had 5% non-residence holdings in our portfolio, and we immediately reached around 26% as of May 2013. Then it gets stabilized because in a way, although the non-resident investors' interest is high, there is a high demand from the local investor base, and I would say that they are complementary. So the short term and middle term, so the belly of the curve, is very much demanded by the local investors, the banks and funds, while the long end of the curve is very much demanded by the non-residents. So I would say that was a very important thing. Then in 2012, 2013, we had changes in the primary dealership framework, and we created specific requirements in terms of bidding in the auctions, acquiring specific percentages in the auctions, and also providing rewards in terms of non-competitive bids after the auction. We also incentivized the non-residents players to to participate in the market by weighting very much their implication on the local government securities market when it came to mandates for our Eurobonds syndicates. So we put a lot of emphasis on the primary dealership and their role on the development of local government securities market. I think that was more or less what we did. So probably I will refrain of speaking about what we are planning to do, because I think that's for the second round of our intervention.
Okay. Thank you so much, Stefan. Again, a lot of good background that now I'm going to try to explore on that with the question to Denise, because one of the ways I was thinking about like conducting this discussion is, first let's think about the changes and the policies that are more under the control of the debt managers. So here we talked about, both speakers mentioned about the debt management strategy, how relevant it was, the debt management strategy. Otávio and also Stefan talked about the auction calendars, having benchmarks. Otávio talked about the importance of investor relations. So Denise, looking and especially also for the audience here, several debt managers, like how relevant are these policies and these transparency policies for you from the investor standpoint, in terms of increasing the attractiveness of this market and making that country to be on your radar screen so that you reach that country? And the second part of the question is related, like Otávio made the question about liquidity. How do you see liquidity indicators, if it is the size of how much of the trade you can do, or if you look at broad turnover indicators? And throwing another angle in the question is how important for you is the composition of this local debt? Are you, like as a foreign investor, you're looking more into the plain vanilla fixed rate bonds, or are investors looking at a more diversified type of instruments in these markets? A lot of questions.
Thank you. Well, I'll just start off with pointing out, I think, a couple of trends in how the markets developed in terms of the investment managers managing local currency denominated debt, because I think there have been some interesting developments in that there are probably three broad classes of investors. You've got the dedicated emerging market managers like ourselves, and we're managing at Lazard about $20 billion in emerging market debt between local currency and dollar-denominated debt. And then you have, so we're a dedicated emerging market manager. Then you have crossover investors, sort of global investors that look at developed market bonds and also look at emerging market bonds. But within so really two classes of investors. And within the dedicated emerging market debt investors, you have kind of a bifurcated market now where you have some big players that are managing over 10 billion, and then you have some smaller players. And I mention that because when you're managing 20 billion like we are, size matters in terms of the local markets. And so, if we just look at, if we had to shift 1% of our portfolio, that's $200 million. So size does matter. The second thing I would mention, so I think that there are some very concentrated players now, and then there are a lot of smaller players and also global bond managers that are moving in and out of that are more tactical, that aren't dedicated. And I think that's a little bit different than 5 years ago, where I don't think the dedicated managers had so much money under management, and it wasn't as concentrated with maybe 10 managers, so to speak. The second thing that we're seeing is that of the 20 billion that we're managing, about 25% of it is dedicated to local markets, and then the rest of it is we're seeing a trend towards investors looking at being much more flexible across the asset class, so they give us that flexibility to go between hard currency and local. So we can, have zero local currency if we don't think it's attractive. So it means that, people are going to be trading more and more, tactical in those allocations. So anyway, that's just the background. But in terms of the things that matter to us, of course, and we've talked about this before, and I won't go on about it, but of course, fundamentals are the most important in valuations. But once we decide that fundamentally we want to invest in a market and the valuations are attractive, then things like auction calendars, having regular auction calendars that are pre-announced, is always very helpful. The most transparency, is always a plus. But what is definitely important, and I think we see that, more mixed when we look at, let's say, Romania versus Brazil, is benchmark issues. Very important. I mean, if you look at Brazil's curve, there aren't that many bonds outstanding. So, in the NTNFFs, you have, 3 or 4 bonds, whereas I think in Romania there are a lot more issues per maturity. So it does make a difference, when you, it's better to have benchmark issues because you definitely have more liquidity around that than having to trade, 3 or 4 different issues within one maturity bucket. Mm-hmm. And, you can do that by, of course, active management, buying back some of the off the runs and, creating these benchmark issues. So when your question about the size, again, we look at if we had to move 1% of our portfolio, we look at that, the dollar amount, not the percentage of the daily, not the percentage of the outstanding as a daily turnover, but what's the actual daily turnover number is important to us. And then in terms of the composition of the debt, we look at nominal bonds, we look at also inflation-linked bonds. So I think it's very helpful when a country offers both. And I think going forward also floating rate note bonds, which we don't look at as much now, but I think that is, those are really the 3 types of instruments that we would look at in a domestic market.
Okay. Well, thank you very much, Denise. I think that let me follow up on some of these inputs. You mentioned some factors like benchmark issues, the relevance, no? And then it's also our experience in working with countries that this is one of the key items, and how to avoid fragmentation of the issues and have those instruments out there. So I would like to discuss these with the countries, but also what is connected there to that we see in many countries is that the decision to diversify the instruments is also a matter of the size of your debt. No? If you want to, it goes back to the benchmark. You cannot have very liquid benchmark issues if you fragment your debt into inflation-linked, floating rate, and nominal debt, and then you have a lot of maturity. So it's a matter also of the size. So I would like to ask both, because you have different experiences on that, like what is the policy on building benchmarks in Brazil? What made Brazil choose fixed and inflation-linked instruments? And then I'll have a question to Stefan on that too.
We have a model that run several debt compositions, possible debt compositions, and then we compare the instruments that you usually have in Brazil: inflation-linked, floating rate, and fixed-rate bonds. And our model shows that inflation-linked bonds are very interesting in terms of matching assets and liabilities, our future revenues, and the theoretical papers about that always go into that direction, that inflation-linked bonds are interesting to compose with fixed-rate bonds as the best or one of the most interesting debt compositions for a country that do not have some particularities, such as, for example, important oil export participation, etc. So, despite some exceptions, in general, countries can have this kind of composition between fixed and floating and inflation-linked bonds. And our model shows us that 35% of our debt in inflation-linked bonds and 45% in fixed-rate bonds is a good debt composition, being the remaining amount 15% in floating rate and 5% in external debt. Basically, this is the, let's say, our optimum debt composition. But you brought a very important point. I mean, if you have a small debt, maybe splitting in 4 different kinds of instruments, and then for each kind of instrument, several maturities. So at the end, we have maybe a very small amount of that outstanding each, and then liquidity would not reach the objective of liquidity. Fortunately, from one side, but not for the other, our debt is not small, so we can we can distribute without having problem in terms of creating liquidity in some points of the education. Just to have an idea. Even with 45% of our debt in fixed rate bonds, you're talking about 20% of our GDP. So we are talking about $800 billion in fixed rate bonds. So you can distribute. Sorry, it's not correct. It's 20% of 45. So it's something like $400 billion in fixed rate bonds distributed in several points of the education. So we can distribute without problem. But there is an important point that when you talk about concentration, so at the same time that you bring liquidity, you bring together refinancing risk. And unfortunately, for several countries, keeping a certain cash position saved exclusively to pay debts, not an easy task. I mean, sometimes they do not receive good return from central banks, sometimes they do not, they have problems in accumulating reserves. So, but it's very, very important if you decide to concentrate your debt that you have this cash position. And then this is a very important issue. Brazil solved it in a very good way. I mean, we keep this amount at central bank. The return is good, similar to the cost of our debt in the market. So we solved this problem. But I know that for several countries, this is not a very easy issue.
Yeah, this is a topic we'll come back on how to deal with in terms of volatility and these preemptive measures. Stefan, you mentioned about the inclusion of Romania in the JP Morgan, Barclays indices, and how this had a huge change in the proportion of foreign investors, etc. And of course, the bonds that are part of the index then are the ones that are receiving all the attention, you know? Which would be the benchmark policy. So how are you deciding on the policies of the size that of these benchmarks and which maturities? What is the policy in Romania?
Yeah, I think you very rightly mentioned that you have to make some decisions on our side, as I explained. So we've started, and our public debt level is not so high. The volume, the outstanding volume of the government securities on the domestic market is now around 26 billion euros equivalent. So, of course, if you scatter through different maturities, that implies that you cannot go with all kind of instruments, both floating, CPI-linked, fixed coupon. So we've chosen to create, fixed coupon bonds, benchmark bonds, and to cover, as many maturities as possible, and also to have various options for specific maturity points. Regarding how we are choosing how we are picking up different benchmark bonds in the auctions calendar, we are very much demand driven. So although we have a model and we do scenarios regarding what would be the optimal for us in an ideal world, I think it matters what's the demand at the end of the day. So we are communicating a lot, and we improved a lot on that in that area, both with non-residents and with the residents, to see what's their focus, what's their demand. For example, when it comes to floating or CPI linked, because the local investors, I will give you an example, the private pension funds, They do not have any obligation to protect against inflation. There is a defined contribution system, so there is not too much appetite on the floaters, on linkers. Then, although we have some feedback that no residents will like floaters, you cannot, put sizable or, take that decision to move to floaters and to fragment the market on the expense of something that, it's more desired by the market. We made a decision. I would say that also the decision of building up liquidity up to around 1.5 billion euros equivalent in some specific benchmark bonds, particularly those included in indices, is important. Although sometimes the liquidity is not good because we still have the largest part of those bonds in commercial banks' hands, and they do not behave as the fund manager. So sometimes they have a kind of buy and hold approach. So they particularly that we pass through a monetary easing cycle. They prefer to keep the government securities portfolio. It was also a specific context when the credit growth was negative, so they were very much prone to acquisitions of government securities.
Okay, thank you very much. Denise, we have so far focused on this part of the policies that are more under control, total control of the debt managers, of picking the maturities, decide on the benchmarks, etc. But we know that the agenda to make the local market attractive is much broader than that. It involves clearing settlement issues, FX markets, how money markets operate, the tax regime, and so on. From the standpoint of an investor, what are the really most relevant factors there? And are there some of these factors that are deal breakers for you as an investor to get in a market or not? And also, how do you relate that to size of markets that we have here, very broad?
So on the, ease of access in terms of being able to set up a local custodian account, to be able to trade the FX with third parties, these are very important. I would say that on the tax side, obviously, we don't like to pay taxes to access the local debt market. So if there are capital gains taxes or withholding taxes, we incorporate those in our analysis of value in the market. But I think the most prohibitive type of taxes are when taxes are put on to discourage foreign investment, and then they're taken off, and so those become less predictable, and that's definitely a deterrent when you have these taxes that are put on to manage the flows into the country. I think there are probably there's probably no optimal way to deal with that, but I think, as a longer-term investor, we always prefer, taxes, if they are put on for that reason, to encourage or not penalize longer-term investors. So if you have a tax that if you're, holding these bonds for longer than a year, then you don't have to pay the tax. And this way you can, discourage the short-term capital that you're trying to avoid, and you can retain that longer-term capital. So if you do need to put on a tax to manage the flows, I think it's wise to kind of think about the types of investors you're trying to discourage, and not at the same time also discourage the longer-term investors that you want to keep in the market. So I think that's pretty much, except I would just emphasize on the settlement side that being able to execute the FX with a third party is extremely important, because there are a number of markets, and Brazil, which is a very liquid market, where some custodians will allow you to execute third party and some won't. So, you know, it doesn't seem to make sense that, you know, why some custodians wouldn't let you execute that FX. So I don't know if that's something that the government's, you know, talk to those custodians about, because there's no reason, you know, to have that kind of bifurcation. And it just ends up costing the Treasury more money, in the sense that it's more costly for the investor to access the market. And the custodian ends up making the money, not the investor or the borrower. So I'd be interested to know why that's the case, actually.
Okay. Why don't we follow up with the countries on this particular question, and then I have another point. Like on the point that Denise was making about the custodian, etc. Would you have any? Is there any involvement on the level of the debt manager's office in Brazil on that, or that's a part of the agenda that's not completely covered yet?
No, we created in the Ministry of Finance a group, a capital market working group to evaluate all the time this kind of issue. But this is a surprise to us. I mean, this issue was never brought to the attention of the. It would be interesting if you could share some perception to see if it's a specific problem of a group of custodians, or if it's a general rule, because we never heard that specific kind of problem. This group that was created several years ago was very important because it involved Internal Revenue Service, Security and Exchange Commission, and even some private institutions. So we advanced in several issues. For example, you mentioned withholding tax in 2006. We reduced it to zero. It was 15%. Capital gains withholding tax. It was reduced to zero in 2006, and then it was let's say the first trigger to start all this process of increasing the foreign participation in Brazil. We also reduced the red tape. The foreign investor needed one specific number for the Internal Revenue Service, and another one for our Security and Exchange Commission. Then we mix both, and then we have in 24 hours the investors receive this kind of number to negotiate in the market. We do not have a restriction in terms of size, so an investor can enter in Brazil with no matter the size. There is no upper limit for foreign investors to invest in Brazil. The whole bureaucracy, considering custodians and IRS, all the process takes for the first time buyer something like 36 hours, between 24 and 36 hours, the first movement. And then after that, the investor can buy daily the bonds without any kind of restriction. So it's very easy, very fast. There is no big red tape problems in Brazil to buy our bonds. So all this process was bought by a working group created by several government institutions, including Central Bank, Security and Exchange Commission, and some custodians to reduce all these problems that we have seen since 2006.
Thank you. But at least we have a positive outcome here that we identified one area to follow up in the policy dialogue.
Yeah, thank you.
Stefan, I wanted to ask you the same question in terms of broader measures, but take into account also that when we're talking about making the market attractive, also looking at the domestic investor base. No? And then as you're having the dialogue with the different segments of the investors, what type of actions you're having to do, and what type of coordination with central bank or other institutions you have to have? What are the measures that are making you go out of your own scope of a primary market measures that you're having to do?
Yeah, we are working now on improving, for example, what is missing from our let's say markets, government security market, is the price disclosure. So we are working now on setting up very clear market making requirements for the PDs, and establishing an electronic trading platform locally, which is going to be provided by Bloomberg. We are already in the testing phase of that facility, and actually we are working on basically including the market the way the market makers will comply with these requirements. The best performers will get points in our system, and then those will be rewarded through different mandates we provide, including here Eurobonds. We are also working in attracting, following, the Hungary model, remoted primary dealers. So here we are working with the central bank in solving, let's say, issues like the connection to the local depository. We are using our depository is located in the central bank, and we found with the central bank solutions to go with a very smooth process. Also, where we worked a bit to diversify the investor base to more retail investors was to reduce the denomination of the bonds. So we were used to have a denomination of 10,000 lei, and we reduced it to 5,000, and now we are discussing to reduce it further to 1,000 RON. Those are basically things related to the infrastructure. I would mention here also the fact that we have now a fully fledged electronic auction system for the primary markets.
Okay. Thank you very much. Now I'll change the shift to have Denise comment last on this question that I have to them. As we're seeing, the composition of the debt towards like a dominance of domestic debt has stabilized at around 90% on average. And we have heard and have experienced times of high volatility. No? So that is making debt managers should be very much aware and think in advance of measures, preemptive measures to deal with times of volatility. So I would ask Otávio on how you're reacting in times of volatility, when you have sell-offs in the market. There is this balance here. How active, proactive should the debt manager be? Or do you just observe what's happening? What type of actions and do you have there prepared for these times? You know?
Well, considering that the foreign investor is more concentrated in fixed rate bonds and very concentrated on the longer end of fixed rate bonds, in terms of volatility, we see sometimes the foreign investor decide to leave the country, and then the longer end of our yield curve moves up very dramatically sometimes, more than would be reasonable, and it's proven after that more than reasonable. But we need to be fast, or try to be fast in trying to find a new point of equilibrium for this yield curve. And the way we usually do, and of course, again, the cash position is very important to do that. First, we stop doing our auctions, long-term auctions, so we stop avoiding including volatility to the already volatile market. Then for a short period, and then we start to do some buyback auctions. We call buy and sell or switch auctions. But in fact, we usually announce 3 days of auctions. We do not announce a cap. We know that there is a cap, but we do not announce it to pass the perception that, okay, you can buy the amount that's needed for the foreign investor to leave, as the exchange rate, the FX market is very liquid, so there is no problem on that side for foreign investors to leave. And then we start to open the first auction, and the sequence of the second one, the third one. What you see is very interesting. First, the market calmed down when we announce the auction. So even without the auction, the market start to try to find a new point of equilibrium, the new interest rate. And then on the first auction, we just see people selling the bonds. But on the second auction, we start to see some people decide to buy the bonds. So, and on the third auction, the last one, we see an equilibrium between buyers and sellers. So it's very interesting that you see that the market just in one, sometimes two, and maximum 3 auctions, and the total amount that you use for this action is very small compared to the size of the debt, compared to the size of the foreign participation in our debt. We are talking about 2 billion, 3 billion reais, so we are talking about 1 billion, $2 billion is enough to stabilize the market. We have done this in 2006, we have done this in 2008, and more recently at the end of 2013, very efficiently we are not adjusting, the objective is not to adjust the yield to the previous position. We know that there is a new equilibrium. We are just trying to find this new equilibrium faster than if you decide not to do it. It has been very efficient, this strategy.
Okay, interesting experience. And Stefan, what is in your toolkit to deal with crisis periods?
Yeah, I think on our side, what we did, and I think it worked very well, as Otavio said, so it's important to have a cushion, to have a buffer. We build up a hard currency buffer in the treasury, which is basically buying protection in the case of volatile markets. So that offers us flexibility in adjusting the implementation of the debt management strategy when we perceive that there is a volatility which doesn't have anything related to our credit story, and it's a temporary volatility. Then we could adjust downwardly our program of auctions. Here we are working on improving further that one, because we still have now monthly prospectus in which we are mentioning the amounts per auction, and we want to do that, build that one a bit more flexible in allowing us to adjust the sizes, just announcing before the auctions. In the past, we were used to be pretty unpredictable in the way we allotted the within an auction. So we had, let's say, many cases in which we allotted lower amounts than we announced. I think now we departed very much from that unpredictable behavior, and we are pretty close to 100%. But I think it matters very much to have this flexibility of adjusting the implementation of the debt management strategy, the funding policy. Also, when it comes, in our case, due to our maturity extension strategy, coupled with, let's say, the fiscal adjustment, I think the gross funding needs went down significantly, so the program we have to implement is going down. So it then creates, let's say, much smoother, let's say, adjustments when it's needed.
Mm-hmm. And Denise, you heard about some of these practices to deal with moments of volatility, etc. From your point that you see several markets, and how they are reacting in moments of volatility. What do you perceive as good practices and that is working well, especially from a standpoint of a dedicated investor that you want to see that volatility dissipating quickly? What is your point?
Well, I think it depends on what is causing the volatility, and as was mentioned, if it's an external event that has nothing to do with the underlying macro fundamentals of that country, then I think suspending an auction, adjusting the size of the auction to kind of smooth over that period makes sense. But I think the what doesn't work is when you artificially try to stop the market from repricing to a new reality. And that is never ends well. So, we generally like to see the market work and things to be transparent and, things not to be manipulated. But I think there's certainly valid that, if there is an external shock that might be temporary, or you want to smooth that out a bit, there's nothing, I think that makes a lot of sense to, use the supply channel in adjusting that supply channel through the auctions and the sizes, temporarily. But generally, we like to see the markets work freely, and if the macro underlying, if there are not a lot of imbalances in the economy, then that should work well without being, very disruptive.
And what we observed here also is that managers are already thinking in advance of measures like having cash buffers, being able to cancel, like to not have to reduce the size of an auction if the volatility if there is a sell-off, etc. No? Do you distinguish or look at countries? Do you go to this level of detail of identifying countries that are being more effective in building preemptive measures, or this is not yet? This is too much detail. It's not yet in Europe.
No, that's definitely when we look at whether or not a market's attractive, that sort of policy track record is important. So if a country does manipulate their bond market a lot in times of stress, that is an issue, and we demand an extra premium. And that, so it does make a difference if that country has a policy of intervening more than they should.
Mm-hmm. Yeah, I think that the challenge here will be to identify what is this level of intervention in the discussion that would be helpful and not shift to the side that it's being detrimental to letting the markets operate. But I think that we'll stop it here to have questions from the audience, because I think that we covered a lot of ground and question issues, etc. So I invite questions to any of the panelists that are here. Okay, we have one question from there. Could you, when you speak, could you please introduce yourself and say where you're from?
Hi, I'm Tembi from South Africa. I'd like to find out from Brazil, what's your longest dated bond and your average term to maturity, and is refinancing risk a concern for you? And my second question is, I saw from your presentation that you're able to decompose the geographic location and the type of foreign investors. In South Africa, we have a particular challenge in that we cannot see who is investing and where they are from, because we clear through Euroclear, and I see you don't have those type of challenges. Can you explain how you're able to do that?
Very good questions, thank you. First, but the longest end of our fixed rate bonds is 10 years. Every 2 years we create a new 10 years benchmark, and then we spend 2 full years building this benchmark, and then we stop and return when it is a 5 years bond. So for example, now in 2014 we started 2025, and then in 2015 I stopped. In December 2015 we stopped after 24 months. So we create this kind of benchmark: 10 years for fixed rate bonds and 40 years for inflation-linked bonds. Our inflation-linked bonds are very long: 40 years, 30 years, 25, 20, several maturities throughout this whole period. So, and this is one of the reasons why we keep 35% of our debt in inflation-linked bonds. They help us a lot to lengthen the maturity of our debt. And then answering your second question, yes, refinancing risk is very relevant for us. Even lengthening the maturity of our debt, 20% of our debt, 25% of our debt outstanding in 12 months. We are talking about something like 10% of our GDP, so it's very relevant. $200 billion roughly per year, so it's very relevant. This is one of the reasons why since 1997 we keep this 3 months cash, unless at least 3 months cash position, to guarantee that we do not have any problem in refinancing our debt. Despite 95% of our debt is domestic, despite 75% being held by Brazilians, so we have a kind of captive demand, somehow can be seen as captive. So we keep this discussion to guarantee, to avoid volatility in our refinancing auctions. and we have similar problem as you. Our central bank, our Security and Exchange Commission, when they receive the information about the foreign investors declare where they are coming from, not originally, but the money sometimes is invested in is a Japanese investment, but through a U.S. fund. So they are registered as U.S., but in fact they are Japanese investors. So we have this kind of problem. What to do is internally we talk directly to the custodians, and we request the custodians that are somehow concentrated. I mean, 80% of our foreign investors are held by 4 custodians. So we talk to them, and they send us regularly, every 6 months, they send us the distribution, geographic, and by kind of investor, not by investor because this is a restricted information, but the groups of, they separate in groups of investors and groups of in countries, and then we join all this information, and it's for more internal monitoring. We do not release publicly regularly this information because it's not official information. It's just, but it's very good for us to have an idea of the movements, what is happening. So we are trying to use other ways that not the official ones to get the information that are important for us and do not have through official means.
Okay.
I just
Other? Yeah.
So I'm sorry.
Yes.
Sorry.
We'll get there.
I'm sorry. Just on identifying the domicile of the investor, and you also are able to identify type of investor. What are the categories?
The custodians, they separate to us the type of investor the best they can. I mean, it's not necessarily.
What is type? I mean, what are the categories of type?
Sovereign wealth funds, retail Japanese investors, institutional investors, pension funds, this kind of.
Okay, we have a question.
Thank you very much. My name is Tasfaye. I came from Ethiopia. I am engaged in debt management. I want to thank you very much for the presentation. Also, I have learned a lot of things from this exercise. Generally, I want to know the challenge you do have when you have increasing from this resident to non-resident domestic debt participation. Generally, what I have noticed is from the side of Treasury, I think Brasilia or Romania have achieved its objective to finance the gap, to get finance. I think there is no any problem from that side. But what I have noticed also from the side of when the non-resident participation is increasing from X% to 95%, that means I think the benefit also goes to this, what you call it, non-residents. What about the local investors? The local investors, what is the balance? What you are doing to balance such things? Because most of the benefit go to this, what you call it, non-resident. If that is the case, I think what is the policy you do have to address such problems? Generally, I want to learn such things because if most of the participation is dominated by non-residents, what does it mean for local investors? That means diminishing their capacity from time to time. In that regard, I think I don't know what you do have for such problems. Generally, I have noticed that you have touched problems here and there, but the general problem you have also noticed, or you have addressed during this transition from the exercise. Thank you very much.
Thank you very much for the question. Perhaps, Stefan, that you had a very drastic increase in the share of non-resident investors. So probably you're well placed for this question.
Yeah, although we have a very drastic increase, so it's still, I mean, the percentage of non-residence holding is stabilized around 20%. So, and we don't see any reasons for a sharp increase of non-residents. I explained, so we have also very much, we have also a strong demand from the locals, and we responded sometimes to the needs of the locals, which were specific needs. For example, we came up in this monetary easing context pursued by the central bank with an instrument which was pretty unusual for a sovereign issuer who is trying to develop the local currency yield curve. So we issued also euro domestically, and that was meant basically to offer an instrument for particularly for commercial banks, but other investors who are looking for euro-denominated instruments locally, particularly since, in this monetary easing, the central bank released, minimum reserve requirements, reducing this level of minimum reserve requirements for the deposits in hard currency. So we are trying to shape our funding policy and instruments, take into account the local demands, specific needs. So it's not that we neglect, but you can also not distinguish between the investors. So you are, choosing a mix of instruments, and then in the auctions. So it depends, because we have competitive bids. So it depends on the interest and on the levels different investors bid in the auctions.
Okay. Yeah, you want to complement?
Just complementing the Brazilian case, what you see is that the capital market in Brazil that was not developed in 2006 we start to see a lot of debentures being issued by companies. So at the same time that the foreign investors start to invest in our bonds, reducing the longer end of our yield curve, at the same time we have seen a lot of companies in Brazil issuing bonds, and then the Brazilians started to buy these bonds through mutual funds or directly. So we do not have a shift of the Brazilian investor from treasury bonds, yes, but several other good opportunities appeared to them to develop our domestic market. So it was good in both senses.
Yeah, so I think that what we get is that it's difficult to distinguish between investors, but that the dialogue with the domestic investor base is very important to identify specific instruments, maturities, that not always will be the same as which is in the interest of non-residents. No? Any other questions from the audience? We welcome. I think we have one from there, Peter, and one there. Let's hear both questions and then we...
Okay. Otavio, it's Peter Stella. I wonder if you could very briefly talk about how the movement from the Central Bank of Brazil using its own instruments, central bank bills, to reverse repos using government securities contributed to deepening the local market. Thanks.
Okay, let's hear the other question.
I have two questions. I'm Harry from Indonesia. One of my questions directed to Otavio about the Indonesia has 38% of foreign ownership of tradable bond, and for us it's quite alarming, because if there is a reversal, it's quite risky to the exchange rate, our exchange rate, because compared to Brazil, our reserve is not so big. And we have a bond stabilization framework kind of fund to prepare for that. I want to ask you, beside the auction you mentioned before, any other framework for stabilize the market in Brazil? Mm-hmm. And sorry, okay. The other one to Dennis. I want to ask, is it the availability of hedging facility or risk management instrument is a very big factor to consider to invest in the local bond market? And because in our experience, even if in our market it's lack of hedging instrument, the foreign investors are still coming, but the yield is kept high. Thank you.
Okay, thank you. So we have now the challenge of 3 questions, and then we have 5 minutes. So efficiently addressing the 2 questions we have for you, and then we have 1.
Okay. Our central bank increased a lot their repo operations, basically to reduce the excess of liquidity, considering the excess of international reserves that the Brazil bought a lot of reserves since 2006, and then central bank need to manage this excess of liquidity in the market through repo operations. The treasury bonds are used as collateral of these repo operations. So our central bank do not issue bonds in the market anymore, but in certain way they do some operations with bonds, or at least on the shorter end of our yield curve, using our bonds as collateral. Central bank goes until the 6 months period, so they do repo operations for 1 day, 45 days from coupon meeting to coupon meeting, so central bank meetings, 60 days, and then 120 days. So very short maturity. The shorter part of the yield of the yield curve is managed by central bank, and all the longer end of our yield curve is managed by the treasury. There is a certain conflict, but we are managing well this conflict, because basically of the size of the repo operation central bank creates a kind of noise, but we can manage together. We are always in coordination with the central bank to avoid this kind of noise. We do not have other instruments other than our cash position, our buy and sell auctions to restabilize the market. But the whole package is very important. I mean, in one side we have this cash position to manage that, but on the other hand, our FX market is very liquid, so a floating rate regime is very important in this sense to adjust somehow this process. We have an important swap market for bonds, or in general for dollars and the yield curve. So as our market is very liquid, so the process is much easier. We know that if you do not have, if one of the legs of this process is not so liquid, so efficient, so we have problems. Fortunately, in the Brazilian case, all the process is very efficient, so it helps a lot. Of course, just the auction is not enough if this whole, it's important, but it's not enough if this whole process is not efficient.
Yep. So on the question of derivatives, I think it definitely, helps in terms of liquidity, because if, we look at markets that do have the ability to hedge, it allows us to hedge our duration exposure more tactically without buying and selling the underlying bonds. But I don't think it helps in terms of, yield levels. I mean, Brazil has probably the most liquid derivative market out there and has the highest real yields in the marketplace. So I think, and it also doesn't necessarily help volatility either, because Brazilian bonds can be very volatile on an intraday basis, despite the fact that they're derivatives. But we do, like that option of being able to tactically hedge and manage our duration exposure without buying and selling the underlying bonds.
Okay. Thank you very much, Denise. I'll just ask if each one of you had any other comment you would like to make, any message to your fellow debt managers. No. And then I have just a very final question to Denise, because one thing that I think that we didn't completely cover here is the fact that frontier markets are coming to the radar screen of investors. A lot of countries are just starting the process of having domestic debt. So Denise, what are the minimum conditions for you to start observing one market that you were not investing, like, and then you started investing? Like, just a quick, what is the minimum condition that market should have? A minimum size, a minimum infrastructure? What is it that would get a frontier market in your radar screen, besides the macro?
High yields and good fundamentals now. I mean, size, obviously is an issue, but that's nothing that you can change. I mean, I think the most important things, once again we make the decision that we like the valuations and the macro outlook in that country, is accessibility. So, easily being able to open a local account, being able to trade the currency, and for the debt office to be as transparent as possible in terms of how the market operates. I think that's, that can be challenging for smaller markets because these kind of flows can be disrupted, and I can understand that you need to manage those. So.
Okay. Now, thank you very much, because I think that's a good way to finish with feedback from the investor to you. Like, I would like to thank the three participants. Welcome further questions during the break. Thank you very much to all for this discussion.